interesting session today. We're going to start with introductions. I can see you've already started, which is great. Let's start down this end, Dan. So just briefly on you and the company, just so that then everybody on the panel and everybody in the room and everybody watching it on the live stream knows exactly who you are.
Yeah, thank you very much for being here. Adelaar, I'm the founder of Adelaar. Adelaar is a debt advisory platform in the Netherlands. Also, we do some capital markets activities, but mainly we do debt advisory. We just founded 5 years ago. In Holland, it was not that common to go to a debt advisor as we know in the UK or in Munich or Frankfurt and New York. There's a very much need on debt advisory in the Netherlands. We have a gap of 3 billion, which has to be filled in by foreign providers. We jumped in that hole. We managed to build up a company with 5 offices, 1 in London, Düsseldorf, 3 in the Netherlands. We are with 21. We have done 3.5 billion in the last 5 years. And so yeah, we are the largest independent advisory team in the Netherlands for real estate financing.
Great, perfect. Thanks very much. Duco, over to you.
Thank you, Richard. Pleasure to be here, so thank you very much. I'm Duco Mook. I'm heading the Treasury and Debt Financing Department of Seabury Investment Management. We have a consistent team of 4 persons in Amsterdam and a few more colleagues in Luxembourg. And I joined Seabury Investment Management in 2011 and in this position in 2016.
Super, thanks very much. Vincent.
Thank you, Richard. Thank you to having me. And my name is Vincent Torion. I'm a partner in charge of the audit in RSM Belgium. RSM Belgium is an audit, accounting and tax company present around the world. And I'm happy to be here. And I don't know, but I'm thinking I am the expert here because I am an external auditor and therefore I have no experience of financing. But I have an external view of the client, what he need, and what is the purpose of request.
Perfect, that's great. Thanks very much. Martin.
Yes, thank you. Thank you for being here. And my name is Martin Basserman, and I'm the chairman of Helvetic Financial Service, HFS. We are a Swiss-based manager of currently 3 real estate private debt funds. We started, and we look back, the history of HFS is starting 2009 as an answer of the financial crisis. We started with mezzanine funds and started in 2009 with 85 million equity in the fund. And today, with around about 1.4 billion, we are one of the largest real estate mezzanine funds in the German-speaking region. So Germany, Switzerland, and Austria. And since a few weeks, we launched also our senior funds, so covering the senior tranche of a real estate financing. And by this now, we can cover the entire capital structure of real estate investments.
Okay, perfect, thanks. It'd be interesting just to start, I think, on... I mean, it's obviously been an extraordinary 12, 18 months for everybody, for all manner of reasons. But the markets especially. So maybe just starting with you, Martin. I mean, how do you characterize, let's take it as the last 12 months, for example, looking at that kind of real estate debt finance market. And then I'll be interested to pick up, because everybody's got such different perspectives on it, it'd be really interesting to pick that up. But let's just start with you, Martin.
Yeah. So when I look back the last 12 months, I think it was quite supportive for our business, because what we see is that as we finance with our mezzanine funds, for example, predominantly developments, also in an early stage, these go over a term of, let's say, 3 to 4 years. Yeah, so they were not immediately affected by the crisis. So what we see is that the demand for our product, for mezz financing, but also for senior, is very, very high. And it has different reasons, I think. When you take a look at the real estate market, you see that there's still a lot of demand for additional housing room, but also for commercial, for offices and so on. And on the other hand, and I think this supports it the most, is that the entire banking landscape cannot cover the demand for new capital, for debt, And so these both really supported our business. So when I look back, we really have a extraordinary high pipeline currently with new products. And we also have from both sides, from the customer side, from the real estate investors, but also from the equity investor side, it's running quite well at that time.
Okay, great. That's interesting. We seem to have lost our panel slide. I don't know why. That will return in a minute, I would imagine. Dan, it'd be interesting to get your perspective on that as well, in terms of how you've seen the last 12 months.
Yeah, obviously Holland is doing well regarding the real estate and the real estate investment. It has a lot of exposure at this moment also for foreign investors. On the banking landscape even. The Dutch banks cannot compete, can compete by only their own balance sheet. So yeah, we only have 3 Dutch banks left. The fourth bank, NEBC, is bought by Blackstone. Goldman Sachs just bought the Nationale Nederlanden Investment Partners. So also from that side we see a lot of investment opportunities. But indeed it's mainly all senior and also much more focused on the topic real estate investments, let's say residential and stuff. But there's a huge demand on mezzanine and the junior providers. Holland is only recovering in the last 5 years on real estate investment because we had a very large and long time real estate crisis. Only in 2015, 2016 the market just opened. So we're always finding new solutions and looking for new business partners coming from abroad, investing who are willing to invest in the Netherlands. In volume, indeed, a lot has changed, and actually in 1.5 years' time, also a lot has changed in the debt advisory possibilities, as the marketing is, for my opinion, more opening and more foreign investors are focusing also to be in the Netherlands. So it's an exciting time. Yes, it is.
Okay, great. And from your perspective there as a borrower, Duco, I suppose, how have you seen the last kind of 12 months, and where do you think we are now in the market?
I would take it a bit longer. I would say let's start with the beginning of the COVID crisis. So that's about 18 months ago. I would say Q2 2020, we've definitely seen a pause. We've seen a pause in new transactions. We have seen investors taking a step back, and the same for the lenders that we have been in contact with. Every sort of deal that was not fully committed needed to go back, as well as on the lending side with banks. It was the same for us as an investment manager. But during summer last year, you could see that, and definitely after summer, it slightly picked up again, but it was definitely, call it a flight to core as you wish. Only own client first, only core play, low leveraged. Offices was debatable, right? We need to see where the working from home would go to. Retail, obviously a no-go area. So really focusing on logistics, on resi. This year, however, this calendar year, I conclude that 2020 was not a fantastic year for the banks, and they don't want to repeat that. So I would say from a borrower perspective, there's definitely more positive sentiment throughout this calendar year. Firstly, again, for the same asset classes, logistics and resi clearly being the winners of this cycle, but not all banks can finance resi. So logistics probably not being number one, but then lenders need to again look at is it offices, is it alternative asset classes, but at least opening up for new business, with still prioritizing their own clients first, I would say.
And is that kind of prioritizing their own clients, is that something that everybody else recognizes in terms of the market from the banks at the moment?
For Dutch clients, yes, it is. And I totally agree with Duco. 18 months, but it's already 18 months ago.
True.
The COVID crisis was a huge, fell down on mezzanine equity. A lot of retrievements from the USA. Even that the Dutch market was still growing. We had the best performance on residential in April 2021. So, but anyway, leisure, hotels, that was not able to finance. But I have to be open that for Adelaar, we have now enough channels to finance next to the Dutch banks, and actually on all areas. It's really, for my opinion, that the market's reopened again and that we are back in business as we used to do. Yeah.
Yeah.
Okay. And is that the same from your point of view, Martin, going forward? Do you see financing being broadly open, that most things can be financed? If you know.
Yeah, I'm not really sure, because one experience definitely was that we had in the last 18 months, predominantly on the resi side, 70% of our entire portfolio is residential, and we also have 70% allocated to the top 7 cities in Germany. So this is quite a preferred situation, to be honest. Yeah. And what we see is that these assets really can stand through this period. You know, they can cover even when it gets bumpy. Yeah. And I believe that this is a strategy that focusing on core, a lot of people are doing this currently. But on the other hand, I mentioned it before, a development normally takes 3 to 4 years, and you need to ask yourself, okay, what is the market asking for in 3 years? Yeah, and let's take, for example, hotel in the moment. Nobody wants to do anything with hotel. Yeah, I'm absolutely sure this looks completely different in a 1 year time already. Yeah, so you need to also see, okay, where is the market going? What is a asset class that really can work? But looking back for the 18 months, I'm absolutely sure focusing on core is probably the best strategy. But now going forward, you need to see what is changing now. By also COVID is stepping back a little bit, and I'm sure that step by step also other asset classes like hotels will come back. Retail is more or less a general discussion. I think will this come again? We do not finance it in the moment. Yeah, but that can change in the future as well.
So you're not financing retail at all? Okay. All right, good. Vincent, it'd be interesting to get your kind of take on some of those themes as you're seeing them at the moment, and some of those trends.
Yeah, I confirm that my colleague said the market change. The COVID-19 has an impact, but in my eyes, the most impact is to increase the trend, because the trends are present before the crisis. And now I observed on the market that my customer requests more funding from private equity, from non-professional investor, and this is new style investment. There is still debt, but the debt is not the debt from the bankers. It's debt from the new investors, and this is new because you should create trust between the investor and the developers and the professionals. And this is the most important difficulties that I see on the market on this moment. Create trust on the future, create trust on the new professional, on the new market, and the new way to deliver money.
Okay, good. And Dan, you wanted to pick something up, I think.
Yeah, I have to correct myself to say that the banks are all open, but that's not true, because I agree that the banks are open for financing really core assets. But what I'm trying to say, that everything can be financed again, is that indeed a lot of alternatives has come for each investment criteria, if it's mezzanine, equity, or even a senior. There are other parties at this moment in the market to finance real estate. So it's not that we only have to look at the banks, because they are suffering enough with Basel IV. Insurance companies, pension funds, Solvency II, that's much easier to finance for them. But indeed, I agree with my colleague on the right side that equity is a big solution at this moment on bridging the gap between financing and getting the deal done. And the Netherlands, we have a shortage of 1 million on residential housing in the next 10 years. Yeah, so, you know, we have more problems to get the permits and to suffer with the permits than to build, finance, or to keep the asset as a core asset.
Okay, good. And Duco, from your point of view, you mentioned the focus on the sectors that were of interest. And how are you capitalizing that in terms of the sort of mix of debt and equity? What's, you know, you're obviously looking at the, you know, as a borrower on exactly those things. So how are you doing that? What's, you know, how are you financing, the transactions that you're making there?
We leverage basically product by product. So we have either certain funds, core funds with definitely low leverage, let's say 30 to 40, 50 maximum LTV, could be asset by asset, could be bigger portfolios, but we also have value add strategies with loan to cost or loan to values up to 70%. I think to make that bridge of your question a bit of on the current lending landscape, in my experience, core lenders, and whether that's insurance companies or the pen brief banks or the local players, but let's say not the alternative lenders, they were pre-COVID definitely willing to finance 65%, maybe even 70% loan to value bullet loans. Nowadays, they definitely have decreased their leverage intentions or require amortization schedules already earlier in the process. And to me, that indeed opens up a niche, and I think Dan is hinting towards that, a niche for alternative debt providers like debt funds, like equity providers in a field, a bit depending, probably asset class by asset class and country by country, but probably in the field between 55 up to 85 or even higher loan to value. Yeah.
Okay, good. And in terms of, I suppose, that, there's been an increased kind of focus on things like, on healthcare, on, life sciences, on some of those alternatives. And there's been a lot of moves from the investment managers as well to begin to move towards some of those, and things that would have been counted as very much alternatives. Is that something that is still getting financed? Is development getting financed? And who's doing that? I suppose is that coming from the the debt funds versus the mezz players? Who's financing? I suppose those more niche areas.
If I may start, to me it's easier for a lender to finance a development loan for an asset class if that asset class is already into play. So let's say if that lender is into logistics, then they can finance development logistics. Debatable on the income risk, so whether it's fully speculative or not. Yeah. I think definitely the core lenders need to have all permits in place, so no zoning risk or what have you. But development risk could be taken, yes. In my view, if a lender has no interest in leisure pre-COVID or let's say 12 months ago, then still it's more probably an internal policy matter. And nowadays they would also have difficulties financing leisure or alternative asset classes, yes.
And are there any sectors where you're keen from a long-term perspective, thinking, okay, well, these are small at the moment, but we'd like to invest in it, where debt is a problem, or can you normally leverage, I guess, existing relationships with finance providers?
We are clearly a relationship-driven party. Yeah, that's correct. I echo the statement from my colleague on the right side on relation to retail. If we have a shopping center with 50% of fashion and a mid-sized shopping center across Europe, I have no alternative than agreeing the terms with my current lender, but I don't have an alternative to go to somebody else. I can be honest. However, my current relationship lenders, they are willing to extend those loans, although they also haven't. They also want to decrease their retail exposure, of course.
Yeah,
you're about to get an offer by the looks of it.
No, just kidding. I know his colleagues, which are more than capable, but indeed, he can always give me a ring. But no, but I do think that we have to be clear that also by risk perspective, for Dutch banks, it's not always not willing, but are not able due to the legislation which is given by the Dutch government and authorities. So sometimes even in a relationship, I have experienced that in several cases, that the relation is more than wealthy enough or can give more than confidence enough for this bank for the loan which is outstanding, but they even could not continue by refinancing or willing to finance. For example, leisure and hotels, they retrieved their offers, but it was not due to the risk managers of that bank, but that was given by the legislation and which is given by the ECB and the Dutch government. And I think that's a huge problem in the banking area. We are always trying to see, for a Dutch perspective, it would be much better to have a much new real estate bank. We have a symposium on 18 November for this topic. But it's very hard and difficult. But that being said, then you have to recalculate, because then alternatives may step in, which obviously will be more expensive. And that's also a hard topic at this moment. You see foreign investors, the hedge funds, which are willing to invest, but the core properties are having yields which are so very low that, obviously also the interest on core properties can be low, that they can still make the returns on equity. But, for DC or residential, we're going beneath the floor. So then now indeed healthcare, other migrants, student housing, all those topics, a lot of foreign investors are looking forward to invest in this real estate investment. Yeah.
Okay, good. And ESG sustainability has been a growing topic and been massively accelerated by the past kind of 18 months. What role do you see finance playing in that, both as a borrower but also as a lender? Are we looking at considerably more green finance initiatives, green bonds? What's your sense of that? And is there going to be an incentive for people to borrow on those terms, i.e. for investors to get a better rate of return? How do we see that moving forward?
This is definitely a big theme, right? It's already a big theme. It has been a big theme over the last few years, and I only see that accelerating over the coming years. That is for the debt capital markets. So yes, for the green bonds. Happy to say that we concluded the green bond literally last week. But also for mortgage-based debt, we see more lenders able, because you need to be able to offer a green loan. In my view, more the international local banks. They're a bit ahead of the game compared to the insurance companies and the German Pembry banks. This is probably less of a theme with alternative debt funds. I'm not quite sure. There's a question for my colleagues, but this will only accelerate, yes, during the coming years.
Okay, good.
No, the problem is obviously it's a very hot and very important topic, but the clients, the borrowers, has to also be able to refurbish existing. New is something else, because every new development or every new investment is nearly green labeled, or can be seen as a green investment. But we in Holland, we have a very huge, I think in Europe we have a very huge gap on the existing real estate, and how you're going to refinance this into these green bonds. So we think that the possibility would be that you, as a borrower or a lender, then you will make a higher loan, which is making it able for the existing owner to refurbish their real estate into a green asset. We have to do by legislation for the 1st of January 2030, label A. So skip the label C, but let's go focusing directly in label A. And that will be in huge demand for these green loans. But I think the problem is the capital market is interested, but they're interested in tickets from 100, 150, 200, 250 million. But I think you have to gather them by 3, 5, 7, 8. And that has to be somewhere. There's a gap between how to provide the capital market into loans which can refurbish the real estate into a green label. So then it will be a green loan.
Okay, good. It'd be interesting as well to just pick up a little bit on interest rates, for example, because there's concerns, across Europe being mentioned a lot, particularly in the UK at the moment, around interest rates, what's going to happen with inflation, interest rates not going up at the moment. But do we see there's a danger of interest rates going up, and what implication will that have on the financing markets? I don't know if anybody wants to pick that up.
Yeah, it's funny that you mention it. As we started in 2015, we went directly to the UK, and what we discovered that the terms in interest are much higher than obviously in Germany. So we are in the middle in the Netherlands, so we are somewhere between. But I think that there's a complete difference on how to invest, what kind of risk, what kind of leverage is being done, and also the returns are much higher in the UK or in Germany or in Frankfurt or Munich, whatever, or in America, than, for example, the Netherlands. So if we have an investment on residential and making a turnover of 15%, that's high in Holland. But if you have to pay 4, 5, 6% on a development loan, it's not able. We're not able to finance. Obviously in London, it's a complete other message because there the turnovers are much higher. So for our opinion, the interest rates in the UK, in the terms which are being delivered, are much more for the mezzanine or equity side, because then they can make the turnover which they're willing to have. In general speaking, Germany has a complete other structure. But I think that the answer to your question is what the interest rate will do. Nobody knows. But obviously, we have signals that in the next quarter, somewhere the interest will raise a little bit. For my opinion, as a professional, I think I cannot imagine that the interest will go much higher in the next 2-3 years. But let's see. We have a lot of topics which influences the interest rate. If I could predict the interest, I wouldn't be sitting here.
No, probably true. Martin, did you have a kind of view on that?
Yeah, in general, I completely agree with what my colleague said. Because, so normally you have the situation that with rising inflation rate, you have rising interest rates, yeah? So currently in Germany, we have a record high in inflation, yeah, with, I think, 2.5 in average in 2021. And this would normally cause a rising interest rate. I'm not sure, as this inflation rate, of course, is a result of all the public influence throughout COVID right now also, yeah. So I'm not sure if this will really happen, especially as the strategy of EZB is probably against that also, yeah. So they continue in their strategy, yeah, buying back the bonds and so on. So I can't predict it, to be honest. Yeah? I don't expect a let's say, significant increase in interest rate, but as you mentioned, you never know, yeah?
Okay, good. And it'd be interesting to drill down a little bit in terms of locations, what is being financed, what isn't, are there views on that? I mean, you mentioned the cities in Germany there, Martin, that you were working. How do you, I suppose, see the difference between some of those locations, or for you, are they all pretty much the same, that they all tick the right boxes? So, how do you see the comparison between the areas, looking at the cities where you're happy to lend in and that kind of thing?
So I would say in general, the top 7 cities in Germany is more or less on one level. Yeah, there are a few which are really preferred, but it's all okay. Yeah. What we also see, and I said before, 70% of our financings are to the top 7 cities. The other 30% are especially in the really fast and strong growing B cities in Germany. Yeah, and this is a very interesting market. They are, from their, let's say, entire environment, they're very, very healthy. Yeah. And when you take a look at the development of the value of the assets, you see that the average rent price, or the increase of the rent price in the B cities, is far behind the development in the top 7 cities. So you have here much more possibility for value increase than you have it in the top 7 cities. Top 7, I would say this is the safe haven, okay? And the real good B cities like Leipzig, for example, yeah, this is really where you can really realize value increase. So I think we will remain in this area. We will have a strong focus on top 7, but also here in the really strong growing B cities in Germany.
Okay. Yeah.
For the Netherlands, it's a little bit slightly different. Obviously, foreign investors are mainly interested in the top cities, the G4. But as being said, we are covering complete of the Netherlands, and what you see is a huge difference between the ticket size and the high terms of the terms of the interest. I give you an example. If you have an office building of, let's say, 10 million, and you have a 50% LTV leverage, we have a duration of 3 years with a leverage on, let's say, 60%, you're not able to finance it in a Dutch bank. So, even the existing loans will be ended by the bank. The alternatives will be the new players, Omeo, that's Blackstone, or Carval, RNB, or even Goldman Sachs will not be. But then we are speaking that we are paying, let's say, 400, 450 above, where normally you will be paying, let's say, 200, 225. In Germany, you have 3,200 banks permits. We have in Holland, we have 3, 4. That's it. So therefore, Adelaar opened an office in Düsseldorf. We have Düsseldorf GmbH to have also an Aanstellung, wie heißt das in English, with the German banks, the small Volksbanken, because in the area of the Netherlands we have a huge Sparkasse Volksbanken, nearly 1,200 or something, which are all being lending out their money for, let's say, 80 base points. So we are happily now to do business with them. Obviously, that's new for them, but even in the normal criteria, financing criteria, they're happy to finance, let's say, 50-60% with a debt yield of 5-6 on terms, let's say, up to 250, 270. So for them, that's a really good business model. And for us, it's also because we are then cheaper, let's say, for 200 base points in the foreign investors in the Netherlands. And that's how we fill it in with our German friends, and get deals done.
Okay, good. And do you see different? Feel free to. Did I stop you coming in there, Vincent? Sorry.
Yeah. I would like to say that when we speak about interest, we speak also about tax, because our interests are fully deductible from the profit until now.
Yeah.
In the coming years, in my view, the state would like to keep it a part of the growth on real estate and will decide to limit the deductibility of the interest. And therefore, on the computation, you should assess the fact that we should pay tax on interest during the construction phase and during the first years of exploitations. And therefore, the rentability expected on the start of the project, on the beginning of the project, will change radically because the tax will decrease the rentability. And therefore, there is important to understand the purpose of the European state about tax on real estate, because there is some regulation in place to avoid evasions, erosion of tax. But I believe that in coming months there is some countries will put in place the limitation of deductibility of the interest, and this is also a risk for the real estate.
Okay, good. Duco, you want to?
Yeah, if I may add to that, I think we need to make a distinction as well between short-term interest rates and long-term interest rates.
Yep.
I think in the middle of the summer, 10-year euro swap rate was like -20 or -25, and as of today it's +20. So that's about 40 or 45 bips difference in just over a month. In the meantime, the 3 months Euribor hasn't barely moved anything. So I fully agree that the ECB will do everything to keep the interest rates low. However, the ECB can only control the short-term interest rates.
Yep.
So for certain investors, for certain borrowers, there might be a risk, definitely towards the capital markets, where you definitely have got the benefit of the negative swap rates if they are negative compared to mortgage rate loans. So that's a clear distinction that I think we need to make, because in my view the short-term interest rates will definitely remain negative, definitely low, but even negative for the coming 2 to 3 years.
Okay, fine. So you don't really see a need to mitigate that risk in the same way as you might do, I suppose, if you were seeing a potentially large rate.
Well, you need to for the long term, right? I mean, on the longer end, let's say in 4 or 5 years' time from now, it is expected that interest rates will definitely rise. The volatility, which I just explained on the 10-year, that is there to remain. So, again, the ECB can only control the short-term interest rates, but on the longer end, 5 to 10 years, if not longer, the volatility is hard to control, right? So you need to be mindful of that. We are a conservative leverage player, and definitely locking in the interest rate suits that profile. So I would prefer to lock it in for long, but towards development investments or towards future pipelines, which is the risk that also we are taking. It's hard to measure and to factor in, of course, the interest rates in a few years' time from now.
Yeah, totally agree with Duco, because the IRS is something else as Euribor. And for long-term investments, obviously, there's also a lot of clients choose for long-term period of interest rate. That being said, the interest gone up, but you see for the top investments, the terms are also decreasing because the competition of the players is also very high. So we see that the huge demand on tickets for larger amounts on real estate, which is being seen as AAA, then the terms are now also decreasing because the competition is much higher for those players. So, but obviously, still very competitive.
And in some of the discussions that we've had so far today, the idea of around non-performing loans, where are we going to be? Is that something that we're expecting to see? Is there a danger that the economy will tank a little bit, and that therefore we're going to have more distressed debt, we're going to have more NPLs coming into the market, or is this very different to previous crises? I mean, what's your sense of that? Do you expect to see there distress in the market going forward?
Well, firstly, this is different than the previous crisis, right? The global financial crisis, it was clearly a liquidity crisis, and all asset classes, all regions, all countries were suffering from a liquidity crisis. Nowadays, we see retail, of course, being hurt by COVID, but also trends has accelerated. So a trend like working from home and offices, a trend like online shopping has accelerated. So that means that the mindset first from investors and lenders are following that, in my view, are asset class focused. So interest in resi has only accelerated as being a winner of the crisis. I mentioned that earlier. Same for logistics. The yields are incredibly low, so people are looking for alternatives. Lenders, investors cautious on offices, definitely on the higher leverage. So we cannot say that the liquidity is not there, because we have tremendous liquidity. But on the other hand, you see investors are making a difference. If I refer to retail, you see investors making a distinction between a convenient shopping center versus a mid-sized shopping center in not the top 7 cities of Germany, but somewhere else. It's time for those lenders to make those alternatives, to make those distinctions between retail as well, because you cannot group all the retail into one bucket. I think investors are doing it, and it's time that lenders do it as well, because we need to make those distinctions. So, not sure if that's an answer to your question, but
No, I totally agree. And secondly, I think that also the finance climate before the crisis in 2007-8, when the fall of Lehman Brothers, was completely different as it is now. So obviously the leverage has gone down, but yeah, that being said, the value is also quite high. I think that we have for the non-performing loans a little bit in the field at this moment with retail, but we have also new possibilities. Writing directly bonds for financing possibilities for our clients. Schuldscheindarlehen, which is also obviously because if we still have 100 million on a value in retail and we have a 60 million need on debt, there's no bank which is willing to finance the retail, so we can cover it with a bond of 4%. So other solutions are being found. But I think we're discussing the crisis, the COVID crisis, which harmed a lot of the leisure and all those kind of markets, event markets, blah blah. I find Evergrande, for example, in China, I find it more exciting to see what will happen. I think China will jump in as a government, as they used to in the early years. But if something would hurt 250 billion on 118 banks, then even Europe and America will feel this. Not as hard as the crisis in 2007, for my opinion, because then we had a problem with ourselves. But I think we cleaned up our balance sheet. So let's see.
Okay, good. There's in fact exactly 5 minutes left. So if anybody's got any questions or any thoughts that they want to contribute, let me know in the next 5 minutes, or else you'll just have to ask them privately afterwards, which is also fine. But I just wanted to pick up on as well, absolutely, if there's any questions that you've got on the live stream, do let me know and we'll try to answer those in the next 5 minutes. But just picking up on I suppose the last part of this, which is, I mean, where do we see, I suppose, the biggest opportunities based around the trends that we've been talking about, where we are in the market? Where will or should the smart money be? That's my question. Whether it's lending or it's borrowing, where should it be? Where shall I start? I'll start with you, Dan, because you were pointing in the opposite direction.
I was looking forward to hear what my colleagues would say. But for a Dutch perspective, and it's completely different as us as a broker, as Duco as an investor. On the lending perspective, we are looking more for alternatives. So the mezzanine, the equity, writing bonds directly on the capital markets, even covered asset-backed, and different financing possibilities as a Schuldscheindarlehen. We even look at blockchain possibilities with the 1031 bank, which obviously I think there will be, not now, but in 10 years, the market will completely change, also by technology. Even that being said, how it will be filled in by crypto, but it's still, when there will be internet, there will be also some solutions coming up. We're following it nearly. Fintech, obviously, that's changing the market rapidly, also in our business side. And so the market is coming more open. And we are focusing more in the alternatives next to the banking possibilities because we need it. And that's and obviously terms are the most important topic for our investors, and so also for us to see in what field rapidly things are changing. We jump in.
Okay, great. Duco, over to you.
Well, as an investment manager, I would like to point two asset classes. Resi, of course, yields are extremely low, but there are a number of investors that 3, 4, 5 years ago could not invest in Resi. There are lenders that still, from a policy point of view, cannot finance Resi in certain countries. So in my view, we have seen a few big transactions, portfolio transactions, but I've never seen a cross-border Resi big portfolio like with offices or with logistics. So in my view, there will still be a very chunk of equity flowing into the Resi play. The second asset class I would like to mention is offices. The office sector is clearly not that. Location was always very important, will remain important, but I think due to COVID has even become more important. Because if people don't want to work from home, but they will come to the office, it needs to be better in the office than working from home using Zoom. So that means different environment, different offices, not only for work, but also to have your Zoom sessions, also to meet in a social environment, to be able to grab a coffee outdoors. Location becoming more important. So I would like to make those two statements.
Okay, great. Vincent.
Yeah, well, in Belgium, I believe that we have two major sectors. Resi, for the evidence explained by my colleagues, and also logistics. I believe that logistics is the right time to invest largely because the habits of the consumer change and change strongly for a long time, and we need a logistic platform to do this new business.
Okay, great. Biggest trends and opportunities in the financing side, Martin?
Yeah, so I think the current market, especially for the private debt side, is not too bad. Yeah, I think the main thing will be that we manage this throughout the next years. Yeah. We have, on the one hand, we have residential. I completely agree with you with office, yeah, especially here in the preferred locations. You really have very good opportunities, especially in the development area. New assets, it's very high demand in the market. And I also agree that the way we work will probably change a bit. I'm not sure if really home office will replace office in total or whatever. Yeah, we will see, I guess, 2 days a week or whatever. But also the infrastructure we have. You know, in the past we believed that open space offices is the way how we need to work. I don't believe that. This will change. Yeah, and this is probably hard to predict, but what we see, especially when it comes to extensions of tenancy agreements and so on, nobody is really reducing his office space. They're all keep it at least at the level they have. Yeah. So I believe residential, we spoke about this enough, I think, today, is a very interesting market. Office in the very good locations is interesting. And then on the other hand, I think, private debt already is established as a let's say, a source of debt for the future beside the normal banking business. Yeah. I spoke to really a large developer in Germany last week, and he told me, I don't need no bank anymore. Yeah, and I think to really manage this, to strengthen the position of private debt out there, and this is what I see the next 3 years. Yeah.
Okay, great. Thanks very much. Thanks very much for joining us. And if you could join me in thanking the speakers, that would be great. Thank you very much.
Thank you.
Thank you, Richard.
Thank you.